Here we go, here we go, here we go, here we go. It is a Fed Live meeting. Let's go. Let's do that again. Hey, what's going on, everybody? This is the Blockchain Backer bringing you the latest cryptocurrency news and analysis. Today, we're going to be covering the Federal Reserve FOMC decision, which is going to be coming out in about 30 seconds from right now. We're going to find out if the Fed is pausing, if they're stopping QT, if they're continuing QT, whatever they're going to end up doing in their FOMC statement that will be issued in just a few moments here. After that, we have about 30 minutes until Jerome Powell comes out and speaks. So if you're watching the replay of this, once this Fed decision comes out here in just a second, you can then skip forward 30 minutes in the replay of the live stream to see the Jerome Powell price action and his statement that does come out here. So right now, in about 2 seconds from right now, we should be getting the FOMC statement, and we'll see how the market responds to it here in just a couple of seconds here. So there it is. There it is. Maintain the Fed funds rate. Beginning in April, the committee will slow the pace of decline of securities holdings by reducing the monthly redemption cap of securities from 25 to 5. The committee will maintain the monthly redemption cap on agency debt. The committee is trying. Okay, so they're saying they'll continue to reduce their holdings in Treasury securities and agency debt and agency mortgage-backed securities, but beginning in April, the committee will slow the pace of the decline. So they're not going to stop QT, but they are going to slow it down. So they're announcing that they are going to slow down quantitative tightening starting in April. Whether that means they will stop by May, we don't know, but they did just state that they are now going to slow down QT. Initial reaction, you got some spiking action happening over here in XRP. Not a whole lot happening here in Bitcoin, not a whole lot happening in the Russell, not a really big change here happening in the stock market currently just yet. So what we tend to see a lot here is we see a lot of volatility, a lot of price action happen throughout here. Many times the moves that we see are fake, one way down, one way up. We don't know in the thick of these moments, and that can all change once Jerome Powell comes up and speaks. And that can all change as we get to the very end of Jerome Powell speaking, if the market hears what they want at the end, or if there was just something that wasn't said that was going to concern them, then at the end, the market will finally decide to make its decision. So right now, we don't really see a huge change happening here in the market, but the Fed did just say they will not be reducing the Fed funds rate. They still will continue QT right now, but they're going to slow the pace of QT come April. So we're not paused on QT, we're not in QE, but they're talking about slowing down the pace of QT starting next month. So let's go ahead and revisit this. This is their statement that came out back in January. So in here you can see the committee will continue to reduce its Treasury securities and agency debt and agency mortgage-backed securities. And that is the conclusion of that statement. Over in here, the committee will continue reducing its holdings of Treasury securities and agency debt and mortgage-backed securities, but beginning in April, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion. So they're going to maintain agency debt and agency mortgage-backed securities at 35, but reduce from 25 to 5 on treasuries. So no change here, but a change on treasuries. So there you go. That's what they got going on there. So we'll hear more from that from Jerome Powell here in about 27 minutes when he comes out to speak. The initial reaction of the market is really no reaction. So if I zoom in on like the 1 minute chart here on the Russell 2000, this kind of gives us an idea of what the market just did here in this moment. Quick whipsaw down, quick whipsaw up, and still just some volatility here and no clear change in range of where we've been at for the last hour or so, or really all morning. So there's really been no big change happening in here. Market, I guess, really isn't very surprised or shocked by what they just heard. So we'll see what happens whenever Jerome Powell comes out and speaks. So, all right, there we go. We had to fly through that to get through the initial reaction in there. I had to build some charts here at the last second before we were able to go live. So what this stream is this is the FOMC live stream. Essentially, a lot of times we see massive amounts of volatility take place in the market during these live streams, which is just the way markets shouldn't work, but it's the way that markets do work. And cryptocurrency tends to move along with whatever the equity market is doing. If you don't believe that, then you're living in a fantasy land. And if you still believe it's attached to gold, you're still living in a fantasy land. So, but what we tend to see is a lot of volatility come out of these meetings. There are times where we don't see a whole lot, but this seems like that was a pretty interesting comment that was made right there during the FOMC statement. So right now, we essentially just kind of hang out for 26 minutes, see if there's any real reactions in the market. Doesn't look like there really are any. And then when Jerome Powell comes out and speaks, I turn my mic off. I stay quiet, and you can see on the bottom left corner of your screen, this whole thing. I'll make this a little bit bigger, kind of like this. I'll zoom in on this for you guys a little bit closer at the time, and we'll watch to see how the market ends up reacting to whatever Jerome Powell has to say, his forward guidance. Are we going to be ending QT? You know, he mentions April, but what about May? How should the market take the stance? What is the reason for why they are starting to slow down QT? All that good stuff, and we'll just see how the market reacts during that. And then whenever it's over, I end up shutting everything down, and we all just enjoy ourselves a nice, fine Wednesday. I don't really have too many comments on price action that happens before, during, or after FOMC meetings. Kind of give the market a minute to digest it and see if it can grab itself a trend. Many times the day before FOMC, we'll see a lot of volatility. Was it volatile yesterday? Yeah, but we've been seeing a tremendous amount of volatility for a couple of weeks. Today, we tend to see a lot of volatility. Tomorrow, we tend to see a lot of volatility. And then by Friday, that's typically where the trend kind of makes itself known, and we kind of have a better idea on what's going to happen with the markets in the shorter term once we finally get to Friday and into the start of next week. But it's like this every single time when we have these meetings. We always have a bunch of volatility in here. You definitely can't trust price action at this exact minute in time to the upside or to the downside, because we all know what happens by the time we get to the end of these things. They can totally be going a different direction. I think last time we had a sell-off right in the beginning, and then by the time Jerome Powell was speaking, it was breaking to the upside, but then the trend still continued down later. So a lot of volatility can happen in these moments, and we just kind of wait it out to see what ends up happening. As for XRP, you guys all know it. XRP had the big news today that the lawsuit was, the appeal was dropped by the SEC. Price action had a little bit of a pump. It's up about 8% today. Market seems to have already priced it in. One of those things you think is, has this thing completely shocked the market or not shocked the market? The fact that Brad Garlinghouse was speaking at an event today, the fact that the news was released minutes before he went on stage, and the fact that it was a pre-recorded video, what does that tell you? A lot of people knew ahead of time. We'll see if anything more comes of this right now. Obviously, a quick pop to the upside on the news, but price is still just kind of stalled out in here. I don't really have any comments on what will happen in the short-term price action with this. Like I mentioned in Markets in the Morning, my thoughts were we were just going to all go enjoy our spring breaks, get your mulch done, get your lawn fixed, get your flowers fixed, anything that died during the winter, go get it replaced. You probably have a week of just chilling in here, but then we, of course, get the big news to pop its way out of here. So we're obviously in a kind of volatile event happening in the market. Then, of course, we're about to have FOMC happen in here. So if equity markets do something interesting and they pop to the upside, well, then this thing's probably going to pop to the upside too. So today in itself, a big day, of course, emotional day to go through it. And when I was talking about this during the live stream this morning, it was weird. It was kind of like, I don't know if I feel anything when it comes to this. It's been over 1,500 days dealing with this SEC versus Ripple thing. And now it's finally over. I think a lot of us maybe got some PTSD of what happened with the Trump pump just 2 weeks ago, where price just popped up really fast and we saw the market take it back the next day. So I think there's probably some PTSD that still sits there from that event happening in there after it gets announced to be included in a Bitcoin or in a crypto strategic reserve, and then it pulls back. So we'll see if momentum can continue itself in here. It's only been a couple of hours since this was announced. I guess it's been a while. Huh? It's been almost 5 hours since this thing was announced. So we'll see if anything continues from that, and probably we're waiting for FOMC to give us a clue on what the market's going to do and if there's momentum. Again, this thing typically, in order to get into expansions or into bull runs, we need the whole market to participate. We need the behavior of the market. But obviously, we're all happy to see us get beyond that moment. As for crypto markets right now, as for Russell 2000 and things like that, it's been up this morning just in general, but no big drastic moves have happened here since the FOMC statement has come out, where there's been no change to the federal funds rate, which was 100% expected or 99% expected. There was no change in the 2-month yield. The CME Watch all said that it was 99% probability there would be no change. And even Polymarket had it at a 99% probability that there would be no change to the federal funds rate. So kind of had a clue that would be the case. The interesting thing that was coming out was when Polymarket was pricing it at a 100% probability that the Fed would end QT before May, which was interesting. We just got the FOMC statement. They did not say that they are ending QT, but it does sound like they are slowing it. So we'll have Jerome Powell come out, and they said they would slow it come April. So we'll see what happens with all of that. But otherwise, yeah, we're still just chilling, waiting for Mr. Powell to come out in here. So I'll just kind of be hanging out in the chat now for the next 20 minutes until he shows up on the bottom left of your screen. And then at that point, we just sit back and enjoy the show. Otherwise, the market's mostly green over here in the stock market. The Russell 2000 is up 17 points. The NASDAQ is up 172 and the Dow is up 225, which is really kind of consistent with what it was already at this morning. As for gold, gold's been up in this range here since Tuesday, so since yesterday. So no big change happening here in gold, no big change happening over here in the dollar just yet, and no big changes happening over here in Bitcoin, which has been stuck at that like $84,000 price level for a little while. We'll see if the Russell can end up getting a break in a move happening in here. Otherwise, it's time now to twiddle our thumbs for 20 minutes. And if you are watching the replay, by all means, go ahead and skip ahead 20 minutes, and then you'll get to see the show happen without having to wait. Ivan says in the chat, he says, do you remember that Jerome said that a strategic reserve couldn't be done a couple of months ago? It's interesting what he is going to say now. I think you probably need to go back and rewatch whatever he said. I'm sure it probably had something to do with the Federal Reserve in regards to a strategic reserve. Congress can do that if they want to. Mate Milinkovic says, it's my birthday and I thought it was going to pump a lot higher. It was probably already priced in. L, thank you for the super chat. He says, hey, BCB, is your DOT target change? Well, we've talked about DOT in the past live streams. DOT's hasn't done anything spectacular. Like, you have to look, like, for me, I have to take into context in the ideas of what happened in 2021 in this market, right? And we don't know what's going to happen for 2025, but we know that 2021 was vastly different from 2017. Only 20% of coins were able to hit all-time highs in 2021 and from 2018. Well, even if you assume that number is going to be the same, which is probably going to be less, right? Who is most likely going to be the ones that are able to break into all-time highs? Probably, right? We don't know. Probably the ones that are already showing strength, right? So is DOT acting in any way uniquely like Hedera Hashgraph or like Cardano or like XRP or like Tron or like BNB? No, it's acting just like a lot of the other ones out there. So I wouldn't. Could it happen? Certainly. It could absolutely happen. It could pull off an Ethereum Classic move, right? Totally not impossible. But I think if you lined up like 100 charts that looked like that, there'd be a couple of them that would probably do it. Will DOT be the one to end up breaking into all-time highs? Don't know. Has high development activity, right? So it's got that going for it. But it's not showing anything in particular right now that makes you really want to say it's crushing it. You know what I mean? Parker says, because XRP got above 250, but it was off the news, does that change the view of the XRP chart? Right. So that's the thing. Like, that's the thing that concerns me at the news. Is does it just come back here and do what we were talking about, where it's like, hey, go enjoy your spring break? I don't know. He says it's amazing how you and DAI said the same thing about being numb to the news. I really appreciate the whole XRP family. Hopefully this starts a new paradigm. Yeah, well, with this one in particular, this was like we all kind of saw it coming. We all expected this, that the lawsuit or the appeal would be dropped. So that in itself is not something of like, wow, you were really keen on picking up on something that nobody else saw coming, right? Now everybody saw it coming, right? The thing that kind of sits with me is like, okay, well, not only did we see it coming, but there was insiders who probably already knew too. The fact that Brad already had a video ready to go, the fact that he was ready to present it on stage, that means all the editors knew, the people at Ripple knew, they were telling people probably, I'm sure, there's no way it didn't get circled around a little bit in circles that it knew, but people knew, right? And I think also just being numb, I think the thing that happened with the Crypto Strategic Reserve just a few weeks ago, that was surprising news, right? That was shocking, right? And then there's the PTSD that came after that. So that's kind of like living in this moment. You know, when you go through things, you kind of put up like defense mechanisms a little bit where you're like, okay, great. This is great. This is good. But I remember what happened 2 weeks ago. You know, like, I remember that. It was cool for one day, and then things changed a little bit. I look like Uniswap just take a big pop right there. I wonder what happened there. All right, you got XRP moving. You got Bitcoin at 86. So you got the Dow, or you got the Russell moving up a little bit. We'll put the Russell on a smaller time. Pew Pew, thank you very much. He says, hey, can Ethereum Classic repeat 2021 because it's something piggy backed from F? I really doubt it. I think that was probably a once in a lifetime thing for Ethereum Classic. All right, we're starting to see some movement happening over here for the Russell 2000 and the stock market a little bit. Yeah, so we're trying to press up against Monday's high, which will take us back to Friday the 7th. So we'll see if we can get something there. But of course, we just want to see what Powell says. Jaxer4 says, thank you for the super set. Says, why was Fibonacci so scared of 5? Because 5, 8, 13. Thank you so much, Jaxer. I think I get that, but I don't think most people do. Right. 4.236 extension of the Fibonacci of the XRP price chart is 13. Thank you, brother. Dinero Crypto. It's crazy. Oh, yeah, I got that one. Yeah, thank you, Dinero. Bill Elliott, new member. Welcome. Thank you so much. Anram. Hey, BCB, I love your videos. Question, do you hold Caspa? I do not. I do not. All right, let's take a look at the markets and see what's happening in here. XRP, of course, still jumping around here. I don't want the Bitstamp chart. I want the Coinbase chart. Here we go. All right, so still range bound, right? Still range bound from the breakout that happened this morning. I think we're all just kind of sitting on our toes waiting to see if that was a temporary news push or if the market has enough juice to lift the whole boat. Bitcoin sitting at 84,674. Russell 2000 knocking on this week's high, trying to also go back against last week's highs as well. Otherwise, we're still just kind of chilling with 12 minutes to go until Jerome Powell comes on stage. Gold pushing at $3,040. DXY 103.65. Bitcoin dominance took a little bit of a move here. Obviously, we know it's still back up at here at the 702 Fibonacci retracement level. No changes happening in here in weeks, as it's just been stalled out in here since early February. So we've been a month and a half just chilling here between the 702 and the 618 retracement level with nothing happening here on this thing. All right, for those tuning in who are wondering what just happened with the Fed, last month we or not last month, excuse me, January 29th is the last time that we had a FOMC statement. And with that one, they maintained the target Fed funds rate, which means they made no change. They remained paused. Of course, remember, if you do remember, last year we had a couple of cuts, but we've now been paused again. They also said that they'll continue reducing their holdings of Treasury securities and agency debt and mortgage-backed securities. We just got the new FOMC statement. Let me go ahead and let me see here. Are there any other big changes in here? Okay, there are things that are different in here. Let's go ahead and just read the whole thing. I don't think I've read it yet. Recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty around the economic outlook has increased. The committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. And considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Beginning in April, the committee will slow the pace of its decline of securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. There you go. This paragraph's always the same, it seems. That was the same. Unemployment low, stabilized, and labor conditions remain solid. I like that term that the Fed's using. They're saying it's solid, bro. All right, inflation remains somewhat elevated. Okay, they did not change the first paragraph. They removed this sentence, and this one's changed. Uncertainty around economic outlook has increased. That's a weird statement. I wonder if that's just about like tariffs or what that's about. I don't know. A little bit odd. And just this is the change in here. So we'll hear from Jerome Powell in 7 minutes. Give me 1 second. I am going to turn the desktop audio off, hide the Fed live stream. I'll look at the Fed. Okay. Turn desktop audio back on. Turn the Fed back on. And there we go. We're good. So there you go. There's the XRP price chart still humming along sideways ever since the big news this morning. Bitcoin at 84,428. No big change happening over here in rates, bonds, bills, and notes. Stock market's up. pressing up against the week highs. No big change happening over in here in metals. No big change happening in the dollar. The VIX is down. Volatility index is down on a day of the Fed. That's pretty funny. No real change. Nothing has really changed in the market at all from this. And this is pressing up against the high, the Russell. So we got a long ways to go to get back to where we want to be, but obviously we're trying to make a U-turn on this Russell, as we've talked about the last week, that there's been bullish divergences emerging down here at the bottom, even on the bigger time frames, the 2-hour, 4-hour, and daily. So it seems like it wants to try to make a U-turn over in here, and that's of course what Senor Bitcoin is looking for as well. All right, back into the chat. TTC, member for 3 months. Previously, you correlated rate pause bullish and rate cut bearish after the fact. Are we aligned perfectly now? Right, so this is where it gets all murky, right? Because did we truly enter a cutting cycle? Right? Because what we do, we cut at one point, and then they stopped cutting, right? Because typically when they're making like real big cuts, it's because something's wrong. But it's almost like were the cuts just election related, right? Because what happened? We went from hiking to pausing to then their last meeting before the election. They came out guns a-blazing, like, good news, everybody. The world is great. Everything is fantastic. We're going to cut by 50 basis points. Right? Then Trump won the election, and then the mood changed immediately. I bet if you go back and you rewatch those streams and you rewatch Jerome Powell speak, and look, I'm not political at all. I don't care who you vote for. I talk about that all the time. Everybody has their own life circumstances. I don't know what goes on in your life. I mean, it's clear that in finance, like probably like 85-90% of people lean Republican, right? I mean, that's just the way it works. But I don't know your life circumstances. I don't know, what your family stuff is, healthcare is like, and, social issues that matter to you or health issues that matter to you. So I'm never going to push that on you. But with what you could see very clearly when it came to Jerome is like right before the election, he starts the cutting process and he comes out with 50 basis points, guns a-blazing. And then the second that Trump wins the election, go watch the live stream. His next meeting is like the polar opposite of what he did in the one prior. But he had already fully committed to cutting. So he still had to do a 25 basis point rate cut. But then like he immediately stopped his meeting as quickly as he possibly could. It was very bizarre. It almost seemed political. So did we really enter a cutting cycle? I don't know. Because how many meetings have we been paused for now? 3? Handy Handicapper says, do you plan on rotating anything into ADA? I'm hoping to rotate profits into it. Do you still think $8 or $10 when you keep updating it? I mean, I hope that's what I'm hoping for, right? $8 to $10 if this market can push off, right? We have to see, like I'm just clear as day, you have to see this being a rotational equity top. It has to rotate. If it rotates, it's probably going to be epic for the cryptocurrency market, but it has to rotate. The Russell 2000 has to go set the high. As for rotating everything into ADA, first of all, you need to have your own conviction, just straight up, dude, because you're not going to be able to. People do this all the time in these live streams. Do you still think this for ADA, for ADA, for ADA? Man, I pray you have your own conviction, man. If I can, I'll try. But if I'm feeling it's late, I'm not playing around with stuff, man. I'm pulling stuff out of the market. I'm not planning on doing a whole lot of rotating in this market. It's about pulling money out. Corey says, I hope we can finish this cycle soon so we can all enjoy a relaxed summer. We all deserve to, yeah, especially the XRP holders, you guys for sure. All right, so here we go. We're all caught up on the chat. Hasn't really been any changes happening in markets whatsoever since the FOMC came out. We had a rate pause, and they've announced that they're going to start slowing down QT in April. Jerome's probably going to elaborate on that here in just a second. And when he does, I will hushola, and that'll be that. So be prepared for that. That should start in a matter of 15 to 20, 30 seconds here, and then he'll come on, and then I'm going to be quiet. Let's go ahead and get it all prepped. There we go. All right. He should be up any second. There we go. All right, guys. I'll catch you afterwards.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place. to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those two kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with, people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers just, they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because you
pandemic.
could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect, by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There is a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't, it's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly. Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon. Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%. While the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter, so I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing. for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right, guys, I'm talking very softly. I'm going to start talking normal. All of you are going to have your volumes up loud because I can't control the volume of the Fed meeting. But here we go. All right. There we go. We made it through the Fed FOMC meeting. The Fed has paused. They've slowed down their rate of QT. He kept talking, why didn't you pause? Or why don't you just, stop QT? He's just saying, what? It seems like the best path is just kind of keep doing it the way we've been doing it. We'll just slow it down a little bit. Essentially cutting it in half, and then they'll kind of take it from there after that. So the market had a pop over here. You got the Russell 2000 popping out. We started down here at 2068. We're now at 2086. Indexes are up. You got the Dow Jones up 519 points, the S&P up 82, the Russell up 37, the NASDAQ up 350. So everything's up about 1.5 to 1.75%. Bitcoin got above $85,000 right here, hitting as high as almost 86. Kind of stalling out here now that the meeting is over. XRP still sits up there at $2.51. You got green throughout most of the cryptocurrency market, and here still, it's kind of where we were when everything started. Gold sitting up there at $3,042. DXY down there at 103.58. Almost really no big changes happening here in markets outside of a little pop over there, getting a 10-day high set over there for Bitcoin. So breaking out above the 10-day high over here. We'll see if it sustains it here overnight, and we'll check in on it again tomorrow morning. Otherwise, QT slowing the rate. No change to the Fed funds rate. And we'll see how prices can maintain themselves and how the market digests this today and tomorrow. Otherwise, that's it for this one, you guys. Thank you all so much for tuning in. Thank you for being here. I appreciate it as always. If you're not subscribed to the channel, please subscribe. We do the Fed meetings about once every 2 months. It's about how often these Fed meetings are, about once every month and a half. But otherwise, we do markets in the morning, live streams every Wednesday, and we have multiple videos throughout the week, typically about 4 or 5 videos every week. But all right, that's going to be it for this one, guys. Thank you all so much for watching. Check out the newsletter at blockchainbacker.substack.com and have yourself a wonderful day. That's it. Thank you so much for watching. If you could, please like the video and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.